Welcome to Stock Talk with Nico Criticos. Today we are going to be going through my bullish thesis for Activision Blizzard stock. And the company just reported earnings a couple hours ago, and the stock is down over 10% today. And so I just purchased 25 shares after hours at an average cost of $71 a share. This will be my starting position and the first time I've ever owned this company. And I think it's being a little too over dramatized about how the company said that their Q4 earnings is going to go down a little bit, which that's understandable. But I mean, in the long term, I think this is going to be a successful company that is here to stay. So if we review their earnings, we can see that revenue for Q3 came in just in line with Wall Street expectations of $1.88 billion for the quarter, as well as 72 cents of EPS. They put up 72 cents of EPS compared to 70 cents expected. Now, and as you read through this, it says Wall Street was looking for $2.95 billion for Q4. And Activision says it's only going to be $2.78 billion now for the quarter because of two of their popular games, Diablo and what's the other one? Diablo and Overwatch 2. Those are the two ones that are going to be delayed. And then Call of Duty comes out in the new Call of Duty comes out in a couple days now. And so that should help it, but they said that it might not be enough. But yeah, Call of Duty Vanguard is coming out in 3 days from now. So with that being said, we are going to use Nico's stock market checklist, and we're going to review all the important things I look for. If the stock hits at least 12 out of these 16, then it's considered a buy. So Activision Blizzard is considered a large cap company, and its highs was at around $104 a share, and now it's at $70 a share. So that is just a little bit over a 30% drop, and for a large cap, it only needs to be down 25%. That's a yes. Stock is down. Net income growth over the past 3 years, as well as revenue growth. We can see here that over the past couple of years, revenue has grown along with net income. So both of those are going to get a yes. Then we have, is the company trading at a low forward PE relative to its competitors and historically? And if we look here, we can see that in the past, its forward PE has been around 25, 27, and now it's trading at a 19. So that is low. We can also look at a company like Sony, who makes PlayStation, and they had traded a forward PE of 21. So it's a little bit lower, but Activision's business model is a little bit different. And so that is going to get a yes, because a forward PE of 19 for a company that's expected to do 12% revenue growth next year, that would be a good deal. And it's probably even, the PE is probably even cheaper than that now because the stock is falling. Smart, how is the management team, and is it founder led? It's not founder led, but if we read about the CEO here, Bobby Kotick, we can see that in December of 1990, he bought a 25% stake in the Activision, and they were almost bankrupt. And then he changed the name back to Activision, restructuring the company, refocused on video games, and became the CEO the next year. And since then, we've seen that the revenue and income keeps increasing, and they've come out with tons of successful games. So it sounds like management knows what they're doing. Next up, we have return on capital, and we can check that right here. Here we see return on capital of 69%, which is insane. That's an insane number. If we compare that to something like a Sony, we can see it only has 6%. Now, I would like to compare this to a Nintendo, but Nintendo's you can't look up. So maybe if we look up something like an EA, we can see return on capital of 22%, a little bit better, but that is not a common thing to find a company with 69% return on capital. So that definitely gets a yes. Next up, healthy profit margins. Activision has profit margins of 29%. Also, those are fantastic margins there. Healthy free cash flow. If we check the cash flow statement, we could see over the past couple of years, cash flow has gone from 2.2 billion, 1.7, 1.8, 2.2, and now 2.5. So we've seen a little bit of volatility. I think it definitely depends on, what games they have coming out that year. But even with some volatility, it still is growing over the past 3 years. And we have the fact that their profit margins are fantastic. So we are going to give that a check. Is the industry growing? Well, for gaming, I believe it is. I know they took a lot of demand out for 2020, but this is saying by 2027, it should reach 156 million for the video game industry market size, which will be a CAGR of over 5% for the next 6 years. So yes, it is growing. More long-term assets and liabilities, as well as we need to check its short-term assets to liabilities. And here we can see they have so let's see, equity growing nicely, 9, 11, 12, 15. Then we can see that current assets of 10, current liabilities of 2, long-term assets of 12, long-term liabilities of 5. All those get a check. Yes. Yes. Increasing equity, yes. Share buyback or a dividend. The Activision does pay a dividend of not too high, but they do pay a dividend of 0.5%. If that, I don't know how much that really counts. The yield's probably a little bit higher now. It's probably closer to 1%. But the more important thing here too is I would say is, are they buying more shares back? So if we look at share change over the past year, it's pretty much break even, hasn't changed. That's good. That's what we want. It would be better if they were buying some back. And I think they've actually increased it a couple percent over the last 5 years, which isn't a huge deal. But okay, our hedge funds, big investors, or insiders buying, we can find that out on this website. And I'm not big into gaming, but I do know that when a company like this that has such a strong brand name and has all these popular games, it's going to be very hard to have this company go out of business or something. It's near impossible. So things like Call of Duty and some of these other games, they're going to be around for years and years to come. All right, next up, insiders. Insiders bought a lot in May when it was trading at $95 a share. They also bought some here in the 80s, and we're getting it at under $70. We're getting it at $70 a share, so that's a good sign. Hedge funds have not been buying. Let's see. Analysts have an average based off 18 Wall Street analysts, average price target of $111, and then the bloggers on this website are more bullish than bearish. So those are all good signs. Well, besides the hedge funds have not been buying, but insiders were buying. Diverse revenue streams, they have lots of games, and so I'm going to count that as a yes. So overall, I'm going to say if this stock goes to, let's say if it goes under $65 a share, I'll probably buy another 10 shares or, probably 10 or 15 shares. And you can see over the past couple of years, this stock has a lot of volatility. It's gone up to in the 80s and down to the 40s. So you got to be kind of careful, because you got to keep in mind that if things go wrong, the stock could come down to the 40s and 50s again. But that's why I just made, a smaller position at $71 a share. I feel like that's a good price. And I see it going back to, if everything goes right for this company, and they keep growing revenue and the bottom line, then it should be over $100 stock again. So yeah, this is my bullish thesis on Activision Blizzard, and thank you for watching.